big news in the last couple of weeks, particularly around Leggett Platt and 3M. Now, these are two industrial, kind of old school manufacturing companies that I have had positions in the past. The humongous news has been that in both cases, after many decades of strong dividend increases from these companies, they have just started to cut their dividend. Now, in both cases, I think this is understandable. I'm going to go through some of the key data today, dissecting what's been going on, as well as looking at what the future may hold for investors, and most importantly, what you need to be watching out for. Let's get into it. It gives us a look at some of the data from the company. So here, for example, we can see that there's a whole load of data here. In recent years, it's been pulled by the business quant team of analysts from the company filings, compiled in a database and made available to us as investors. And we can see here that there's a bit of a shift here in 2020 in terms of how they segregated the different product categories, but we can see here the current range here in building products has been on a downwards trend in the last couple of years. To some degree, the furniture, flooring, textile products has not been doing too well either, with the specialized products doing reasonably well, or at least holding steady in terms of revenue. Now, of course, revenue is one thing. What, though, is going on elsewhere? And I think this is where we can also get a lot of insight here by switching over to the earnings before interest and tax EBIT data. And we can see here that the bedding products was pulling in 100 million here. And then in the recent 2023 quarter four, this had dropped down to $10 million of EBIT. That's a substantial decrease. Now we can also see here as well, the furniture, flooring, and textile products had decreased, and specialized products were going sideways. Have been dropping for Leggett and Platt, and their earnings for the segment have been dropping. Is this just a Leggett and Platt problem, or is this a wider macroeconomic problem? Now, we know that sales have been tough in many sectors, and we know that the cost of living has been challenging. Here's an article from website Furniture Today. We can see this is from late 2023, and it suggests that 2024 could be a turning point for bedding players. Now, the forecast here is that the industry would wrap up with a 12% decline in unit shipments, as well as a 7.5% decline in the value of mattresses. And then in 2024, the industry is looking at a modest increase in the value of shipments, while a relatively flat level of the number or the quantity of shipments. So there's a higher average selling price. Now, I think this plays into Leggett and Platt's sort of market positioning really well, but at the same time, it does sound challenging. But this is probably a key point here as well. The 3-year downward slide for the category is forecast to come to an end in 2024. So what does this mean? It means that Leggett and Platt may not be out of the woods yet, but the core issues here that have been outside of their control may be coming to a close. Revenues haven't been the strongest. There's some challenges there with the earnings as well. Now, this was from a couple of weeks before the dividend cut from one of the Piper Sandler analysts. And they reduced their price target. Now, the big issue that they saw here was the way in which the leverage ratio was nearing the limit set by debt covenants. Now, that would potentially lead to the loss of an investment grade credit rating if there was another downgrade. And so that increased the likelihood that the company might redirect funds to strengthen the balance sheet and preserve its credit rating. I didn't think that they, as a company, would take that pathway, but certainly that's what the management signaled. And certainly, as we begin to look at the savings from paying out those dividends, we see that it can make a reasonable impact. Now, the debt maturity profile is not as severe as it may seem. There is some reasonable debt there in 2024, but then also quite another big gap until a big lump is due in 2027. But the 2024 corporate debentures is only about $300 million. Is that so big in the scheme of things? Let's have a look. As we begin to look at their overall position, just looking down here at the cash flow, we can see that the common and preferred stock dividend payments have been increasing as we would expect every year. hitting here in 2023 about $240 million. Now, as we begin to look at free cash flow per share, so free cash flow, it has been lumpy. They've got barely enough free cash flow in 2023 to meet the corporate debentures. Um, and so when you think about this, by simply lowering the dividend payments that they have done, they've allowed themselves much more leeway in terms of meeting their debt obligations, and that's going to enable them to be in a much better position moving forward, in a position where they're not going to breach those debt covenants, and that puts them in a much stronger position. Now, could they have made other decisions? I suspect they possibly could have managed in their current approach in a way where they could have met those debt obligations and not run into the debt covenant issues. However, it certainly would have been a riskier pathway. I think the management team's taken a very wise approach by managing the debt in this way, even though I'm sure there's howls of dismay for many dividend investors. But certainly, when you look at the numbers, it hasn't been the strongest investment, and it's definitely now looking like a turnaround investment play. When you begin to look at the valuation here, it's looking absolutely catastrophically good in terms of the valuation, but also at a very weak point in terms of margin and profitability. So, what we're seeing here is this is not really a place where this company wants to be, particularly here as well when we begin to look at the leverage metrics here and the issues here that this would raise with the debt covenant. It is obviously getting rather bad, and we can see it's very much out of whack with the consumer discretionary uh, sector within the US and Canada as well. So, in a much worse position here. I don't think the debt was unmanageable, but it certainly is a brave company and management team that has taken the step that they have taken, while they also continue to engage in other steps to address the challenges that they're having in these different product categories. So, what does all of this mean moving forward? It isn't, I think, a bad organization. I think the long term investors at the right price will still find themselves rewarded. And I suspect as they get through these debt issues, as they shore up their sheet, they're going to begin to see some improvements here. There's a forecast relatively flat levels of sales out for several years, as well as gross profit. And we can see that there's an expectation by the analysts that they're going to be eking out some small gains in EBITDA, and adjusted EPS is likely to gain marginally as well. But as you can see here, it's still far below the adjusted EPS per share, earnings per share that we sort of saw in 21, 22. So I think we're looking at a situation where a good long-term investor who's comfortable with the sector could potentially do well. I could also look perhaps at options and say, hey, look, if you're into playing options and you're comfortable playing options, this might be a good opportunity here following the big price drop to play the options here with the expectation that the company's going to stabilize and begin to increase the dividend over several years. I think there's a number of different ways of playing this, but in all these cases, it is not an area, as I sort of suggested in the last video, that I'm comfortable, and it's certainly not a company that's on my radar as a potential investment either. Is it a value trap? No, but it is definitely a company that's going through a tough time.